Stock Market for Beginners. Section 1. The Basics. Why investing matters. Investing is an effective way to put your money to work and potentially build wealth. Smart investing may allow your money to outpace inflation and increase in value. Investing has a better chance of making money grow because of the power of compounding and the trade-off between risk and return. The power of compounding. Compounding happens when earnings or dividends from an investment are put back into the same investment. These profits or dividends then bring in more money on their own. In other words, compounding is when your investments earn money based on the money they have already earned. If you buy a stock that pays dividends, for example, you might want to reinvest the dividends to take advantage of the potential power of compounding. The risk-reward trade-off. There are different levels of potential return and market risk for each type of investment. Risk is the chance that an investment will give a lower return than expected or even lose value. Return is how much money you make from the assets you've invested or how much the overall value of the investment goes up. For example, putting money into stocks could give you a higher return. Investing in a money market or savings account, on the other hand, is less risky than investing in stocks, but you probably won't get as much money back. How much risk you take depends on how much you like or can handle risk. You are the only one who can decide how much risk you are willing to take in order to make more money. But if you want your savings to grow faster than inflation, you may need to take some risks. To get the most out of compounding, start investing as soon as possible and have your dividends and other distributions automatically reinvested. What is a stock? A stock is a unit of ownership in a company. If you own a stock, you are a shareholder, which means you may be eligible to receive dividends if the company succeeds, and you may have the right to vote on certain company decisions. Stocks are an important part of the global economy because they let companies obtain money to run their businesses by selling shares to the public. You can buy or sell shares on an exchange, like the New York Stock Exchange or NASDAQ, through an online stockbroker. Why buying stocks can be a good investment. Over time, the stock market has helped people make a lot of money. Putting money into stocks, or the S&P 500, which is made up of 500 of the largest publicly traded companies in the U.S., has returned between 8% and 12% per year on average. If you had put just $10,000 in the stock market 50 years ago, it would now be worth more than $380,000. But keep in mind that the stock market doesn't always go up. About 3 times every 10 years, the S&P 500 falls. Some drops can feel really bad, and not everyone likes how volatile it is. But if you can get over your fear, stocks have the potential to give you much higher long-term returns than other investments. Advantages of putting money into stocks. Putting money into stocks has a lot of benefits. The 7 big ones are: 1. The chance of making more money. Most people invest in stocks because they have a better chance of making money than other options like bank certificates of deposit, gold, and treasury bonds. For example, since 1926, the average return on the stock market has been about 10% per year, while the average return on long-term government bonds has been between 5% and 6% per year. 2. Being able to keep your money safe from price inflation. Most of the time, the returns from the stock market are much higher than the rate of inflation. For instance, since 1913, the long-term inflation rate has been about 3.1% per year. That's like a double-digit return on stocks every year. Investing in stocks has been a good way to protect against inflation. 3. The ability to make regular money without doing anything. Dividends are a way for companies to share some of their profits with their investors. Most companies pay dividends every 3 months, but some pay dividends every month. Dividend income can be a nice addition to an investor's salary or income from retirement. 4. Taking pride in what you own. A share of stock is a small piece of a company's ownership. You can own a small piece of a company whose products or services you love. 5. Liquidity. Most stocks are traded openly on a major stock exchange, which makes buying and selling them easy. It also makes stocks a better investment than other options like real estate, which you can't sell quickly. 6. Diversification. With stocks, it's easy to build a portfolio that has investments in many different fields. They can help you spread out your investments, which could also include real estate, bonds, and cryptocurrency, lowering your overall risk while improving returns. 7. Being able to start out small. Investors can start buying stocks with less than $100 because many online brokers don't charge commissions and let you buy fractional shares. Risks of putting your money in stocks. Now that we've talked about the pros of investing in stocks, let's talk about the cons. The biggest risk of investing in stocks is stock market volatility. On average, the stock market falls 10% from its high every 11 months, 20% every 4 years, and more than 30% at least once every decade. You might not want to buy stocks because of the following. You can't stand the idea of your investment going down by 10% or more. Within the next 3 to 5 years, you'll need the money for a down payment on a house or another big purchase. You're retired or getting close to retirement and need a steady income more than the chance that your stocks will go up in value. Why should you invest as soon as possible? There are some good reasons not to buy stocks, but for most people, the upside potential is worth the risk. So, investing in stocks is almost always a good idea, even when the market is at an all-time high. Studies have shown that the amount of time an investor spends in the market is more important than how they time the market. It can be expensive to wait for the right time to buy stocks because most of the gains come from a small number of days. Stocks, on the other hand, tend to bounce back from corrections or drops in earnings of more than 10% in a few months. The less likely it is that an investor will lose money the longer they stay in the market. Choosing the right stocks to buy is just as important. It doesn't matter when you invest if you invest in great companies. Most of the market's overall return comes from a small number of stocks. That's why it's better to buy stock in a great company as soon as you can instead of waiting for a better price that might never come. What is a stock exchange? A stock exchange is a place where stocks, bonds, and other types of securities can be bought and sold. It gives companies a place to sell stocks and investors a place to trade those stocks with each other. This all happens in a regulated space that tries to make everything as quick and clear as possible. Around the world, there are many stock exchanges, and each one serves a different market. For example, the NYSE is one of many stock exchanges around the world, but it's also the biggest based on its market capitalization, which is the total value of all the stocks that are traded there. In the past, stock exchanges were mostly places where men stood on the floor and shouted buy and sell orders. Most exchanges happen online these days, with computers putting together buyers and sellers. The NASDAQ is a great example of an electronic exchange that began operations in 1971. How do stock exchanges make money? For example, the NASDAQ is a global electronic market where many of the world's biggest tech companies, like Apple and Google, are listed. The NASDAQ has a number of linked services that cost money to use. Large tech companies pay different fees to be listed on the exchange, and individual investors pay transaction fees to buy and sell securities. The NASDAQ Inc.'s 4 main lines of business and how they make money are: corporate services. Companies that want to list on the NASDAQ have to pay fees. Info services gives users different market data and research to help market participants learn more. Brokerage and clearing services fees are added to all trades. Services related to technology, such as investor relations, public relations, and governance. What is an index? An index is a standard way to keep track of the performance of a group of assets, like stocks. Indexes usually track the performance of a group of stocks that are meant to represent a certain part of the market. For example, the S&P 500 index tracks how about 500 of the biggest publicly traded companies in the U.S. do on the stock market. The index is made up of the top companies in the top industries. It is capitalization weighted, which means that each stock is given the same amount of weight as its market value. For example, a company with shares worth $100 billion is given more weight than a company with shares worth $10 billion. What is an index fund? Index funds are investment funds that track a benchmark index, like the S&P 500 or the NASDAQ 100. When you put money into an index fund, that money is invested in all the companies that make up the index. This gives you a more diverse portfolio than if you bought individual stocks. Index funds aim to hold the same stocks as the index they follow. Because of this, they are naturally diversified and have less risk than holding individual stocks. Market indexes have also done well in the past. Even though the S&P 500 does change, in the past it has given investors an average annual return of almost 10%. Index funds are an easy way to invest with low fees. It might be the smartest and easiest investment you ever make. Warren Buffett, one of the greatest investors ever, famously said, "In my view, for most people, the best thing to do is to own the S&P 500 index fund. People will try and sell you other things because there's more money in it for them if they do." Index investing is a form of passive investing. Investors in an index fund don't have to manage their stocks and bonds as closely because the fund just copies an index. This is why index funds are called passive investments and why they are different from mutual funds. What is a mutual fund? Mutual funds are a form of active investing. Mutual funds are actively run by people called fund managers who choose how your money is invested. The goal with mutual funds is to beat the market, while the goal with index funds is simply to match the market's performance. Since mutual funds are managed by a person every day, their fees are higher, so by investing in index funds, you can save lots of money in the long term and in turn help you make more money. Mutual funds are companies that take money from many investors and invest it in stocks, bonds, and short-term loan debt, and are popular with pension plans. Investors buy shares in mutual funds, and each share represents an investor's part of ownership in the fund and the income it generates. Mutual fund trades are executed once a day at a single price. What is an ETF or exchange-traded fund? Similar to mutual funds, an exchange-traded fund is a sort of pooled investment vehicle. ETF often track a particular index, sector, commodity, or other asset class. However, unlike mutual funds, ETF can be bought and sold on a stock exchange in the same manner as common stocks, and trades can be executed many times a day at different prices. By combining the diversification advantages of mutual funds with the simplicity of stock trading, ETF provide investors with a straightforward means of accessing the global financial markets. An ETF can also be designed to track the price of anything from a single commodity to a wide portfolio of securities or investment strategies. There are many categories of ETFs such as stocks, bonds, sector and industries, and commodities. The list on the right is some of the best performing ETF over a 5-year period. Congratulations! You have completed Lesson 1. I hope you have enjoyed the first tutorial video in this complete Guide to the Stock Market for Beginners video series. Make sure to like and subscribe to never miss a video in the series, and leave a comment about where you are watching from. See you on the next video. Stock Market for Beginners. Section 1, The Basics, Part 2. How to make money in stocks. Ask any financial guru, and they will tell you that investing in stocks is one of the keys to creating long-term wealth. The difficulty with stocks, however, is that while their value can increase exponentially over time, it is hard to anticipate their daily movement with absolute precision. But actually, it is not difficult if you follow some tried and true methods and exercise patience. 1. Buy and hold. Long-term investors have a frequent saying, "Time in the market beats timing the market." What does this entail? A traditional technique to make money in stocks is to adopt a buy and hold strategy where you hold stocks or other securities for an extended period of time rather than engaging in frequent trading. This is significant because investors who often enter and exit the market on a daily, weekly, or monthly basis typically miss out on possibilities for substantial annual returns. People who remained completely invested in the stock market for 15 years through 2017 had an annual return of 9.9%. However, if you entered and exited the market frequently, you compromised your chances of achieving those returns. 2. Opt for funds over individual stocks. Diversification, a time-tested investment strategy, is the key to lowering risk and perhaps increasing profits over time, according to seasoned investors. Consider it to be the equivalent of not placing all of your eggs in one basket. Although most investors gravitate toward two investment types, individual stocks or stock funds, such as mutual funds or exchange-traded funds, experts typically recommend stock funds to maximize your diversification. While it is possible to replicate the automated diversification found in mutual funds by purchasing a variety of individual equities, doing so efficiently might require considerable effort, investment expertise, and capital. For example, a single share of a single stock can cost hundreds of dollars. Funds, on the other hand, enable investors to purchase exposure to hundreds or thousands of individual investments through a single share. While everyone wants to invest in the next Apple or Tesla, the reality is that most investors, especially the pros, have a poor track record of predicting which firms will generate outsized profits. Experts advise the majority of investors to invest in funds that passively track large indexes, such as the S&P 500 or NASDAQ. This places you in the best possible position to profit from the approximately 10% average yearly returns of the stock market. 3. Reinvest your dividends. Numerous organizations distribute dividends to their shareholders, which are periodic payments depending on their profits. When you first begin investing, the dividends you receive may seem insignificant. Nonetheless, they have contributed significantly to the stock market's historical growth. From September 1921 to September 2021, the S&P 500 returned an average of 6.7% annually. However, when dividends were reinvested, that proportion increased to nearly 11%. This is because reinvesting dividends allows you to purchase additional shares, which accelerates the compounding of your earnings. Most online brokers offer the option to automatically reinvest dividends. Understanding primary markets, IPO, and secondary markets. The primary market is where securities or stocks are first sold by a company and bought by investors before they become available for trading on a stock exchange, usually via an IPO. An initial public offering is the first time a private company sells shares of stock to the public. In essence, an IPO means that a company is going from being privately owned to being owned by the public. Because of this, the process of having an IPO is sometimes called going public. The secondary market is where stocks and bonds, issued previously, are bought and sold after being initially offered in the primary market via an IPO. It is what most people think of when they hear the phrase stock market. Stock exchanges like the NYSE and the NASDAQ are examples of secondary markets. What is dividend investing? Dividends are paid to stockholders as a way to reward and entice new investors. A company will share some of its earnings determined by the board of directors and approved by shareholders through a cash dividend or a dividend of stocks. Dividends are paid yearly, quarterly, or monthly. Larger, more established companies with predictable profits and less volatility in price will usually pay the best dividends. Smaller startup companies are less likely to pay a dividend. To qualify for a stock dividend, you must hold the stock or buy before the ex-dividend date. Important dividends dates. Announcement date. This is when a company will announce the dividend rate, payment date, and ex-dividend date. Ex-dividend date. This is the date when traders who buy stocks on and after will not be eligible for a dividend payment. Basically, you need to buy stocks before this date to qualify for the dividend. Record date. Simple put, this is the date the company makes a record of which stockholders are eligible to receive the dividend. The record date is usually the day after the ex-dividend date. Payment date. This is the date when the dividends will be paid to the stockholders. By the way, you can search Google to find these dates for each stock. How do dividend stocks work? Consider the following example. Suppose you purchase 100 shares of a firm for $10 per share, and each share pays a yearly dividend of 30 cents. If you invested $1,000, you would get $30 in dividends over the course of a year. That corresponds to a yield of 3%, which is not bad. Here are some popular dividend stocks that pay dividend yields of greater than 3%. Remember, it is your decision what to do with your dividends. You can reinvest the funds to purchase additional company shares, purchase shares of a different company, save your money, or even spend the cash. How are stock prices determined? When a firm goes public on the stock market and its shares begin trading on an exchange, supply and demand determine the share price. Long-term, however, share prices are decided more so on the business's economics. Other variables can influence prices and generate sudden or temporary price fluctuations. Examples include earnings releases, important company events, political events, and economic news. Market news can cause fear or confidence in a stock price, causing traders to buy or sell. When traders sell, the price drops, and when they buy, the stock price rises. What are stock splits? A stock split is a way for a company to increase or decrease the number of shares it has on the market without changing its overall market value or capitalization. For example, if a company doubles its number of shares by giving investors one more share of stock for every share they already own, each shareholder will own twice as many shares of stock. But the total value of all outstanding shares won't change because the company won't have gotten any more money. The primary advantage of a stock split is that it makes a company's shares more affordable for small investors to purchase. Throughout their history, numerous corporations have occasionally divided their shares in order to maintain a desirable share price. Forward splits are the most prevalent type of stock split, in which a firm expands its share count by issuing new shares to current investors. In the case of a 3-for-1 forward split, if you own 10 shares of firm XYZ prior to the split, you would hold 30 shares following the split. A reverse split is another sort of stock split that operates in the other direction. Existing shareholders' shares are replaced with a proportionally lower number of shares. A 1-for-3 reverse split, for instance, involves the replacement of every 3 shares owned by investors with a single share of stock. Therefore, if you owned 30 shares of a company's stock prior to the reverse split, you would now hold 10 shares. It is crucial to note that a reverse stock split generally, but not always, occurs after a significant decrease in a stock's price, for example. What's the difference between stock trading and investing? Trading and investing both involve seeking profit in the stock market, but they pursue that goal differently. The main difference between trading and investing is that traders jump in and out of stocks within weeks, days, or even minutes, aiming for short-term profits. Investors have a longer-term outlook. They think in terms of years and often hold stocks through market volatility. The focus of traders and investors is also different. Traders often focus on a stock's technical factors rather than a company's long-term prospects. What matters to traders is which direction the stock will move next and how the trader can profit from that move. Investors study a company's potential for long-term growth or value, then buy and hold. But traders often take advantage of small mispricings in the market, such as when political uncertainty in a foreign country temporarily pushes down the share price of a U.S. manufacturer. Scalp traders might be in a position for just minutes. Day traders are focused on a single trading day, while swing traders invest for days or weeks. Congratulations! You have completed Lesson 2. I hope you enjoyed the second tutorial video in this complete Guide to the Stock Market for Beginners video series. Make sure to like and subscribe to never miss a video in the series, and leave a comment with your thoughts and opinions of this video. See you soon. Thanks for watching till the end.